Hi, this is Richard Flax at MoneyFarm with our regular monthly video. As we all come back to reality after the holidays, we wanted to take a look back at 2024 and set the stage for the coming year. 2024 in financial markets may have ended on a fairly subdued note, but the year as a whole was pretty strong across most MoneyFarm portfolios. US equities led the way, driven by the largest companies, but we saw positive returns across most global equity markets. On the fixed income side, the returns were more muted, with government bond yields generally ending the year higher than at the start. First, the macro backdrop remains mixed. The US economy continues to perform well, driven by consumer demand. Growth elsewhere in the world is positive but a bit more muted, particularly in parts of Europe and China. But we aren't expecting to see a recession in the near term. Second, central banks have begun to bring down policy rates, even while the global economy continues to expand. That combination of lower rates and a growing economy should be supportive for corporate earnings and financial assets. Turning to valuations, the picture again is a bit mixed. On the equity side, US equities look quite highly rated compared to history, but a lot of that is driven by the large tech companies that are delivering high returns, strong earnings growth, and good cash flows. Expectations for these businesses remain high, but we think the long-term potential for secular drivers like artificial intelligence is very significant. Outside the large US tech businesses, valuations look more attractive, but the earnings outlook here is a bit more subdued. Here's where we think lower interest rates could have an impact, potentially helping to improve demand and earnings growth over the coming 12 to 18 months. On the bond side, it's another interesting story. Yields remain quite high, certainly compared to the years between the global financial crisis and COVID, and that should provide an important source of returns, particularly for low-risk portfolios. But the spread between government bonds and corporate bonds is pretty low versus history. You don't get a lot of additional return for taking on that extra risk. With a decent economic backdrop, that might not be a problem, but it's something we continue to discuss. Inflation is probably going to remain an important topic of conversation in 2025. We've seen inflation rates come down a lot over the past year, but the pace of that decline has slowed as we've gotten closer to the 2% target. With the demand still generally growing and interest rates coming down, we could see inflation stabilize above the central bank's target level. That would give policymakers less room to maneuver, especially if we see global growth re-accelerate. We think there's still room for policy rates to come down this year, but possibly not by that much. Finally, we know that the geopolitical backdrop will remain complicated, particularly with the change of administration in the US. We'd expect the new administration to hit the ground running as it aims to implement its agenda, but the exact shape of those policies is still unclear. As we've discussed before, we think at a high level the policy proposals are another mixed bag for financial markets. Lower taxes and less regulation should help support US companies, but the prospect of higher trade tariffs could put pressure on exporter-oriented economies and businesses around the world. So 2025 is shaping up to be an interesting year. We see lots of opportunities, but possibly a few challenges as well. With so many moving parts, we think it's important not to be too distracted by all the noise. We use our Strategic Asset Allocation process, which we run annually, as a way to help us stay focused on the long term, looking at expected returns over the next 10 years. We've shared our latest version of this over the past couple of weeks. Our long-term forecasts suggest that expected returns aren't quite as high as they were a year ago, not surprising given the strength we saw in 2024, but that the long-term outlook remains pretty decent, helped particularly by solid expected returns in fixed income and non-US equities. We'll discuss that in more detail in the coming weeks. Thanks for watching and look forward to speaking to you again soon.